So guys, this is the third and final step when it comes to commercial construction financing. As part of our team, you discussed, number one, construction budgets and a prospectus, a loan summary of what's the deal. Number two, we discussed the second step, which is corporate documentation. And number three now, it's personal information. Who are we speaking about? The principals, the sponsor, the developer, whomever are the majority share owners of a specific entity, which is going to be the ownership of the development company, right? Who's taking on this project? So very basic. It's not rocket science. We all know these 4 key steps, but specific to construction financing, it kind of takes a little bit different of a turn. So these are the 4 components of step 3, personal financial information. So here are the 4 steps. Number 1, 3 years of personal tax returns. Very simple, right? And so if your customer has a lot of different entities, they would have 2 things. 1, a K1 statement, right? That comes alongside of all the different sub-entities that they may have. It talks about how much they receive in distributions. This is called true cash flow, right? So we don't want to go too far into it, but ultimately, when we request for construction financing, personal financial information, first step is going to be 3 years of tax returns. And if they have an available K1 schedules, that would be perfect for that specific year, right? So 3 years of K1 statements would even be better. But long story short, true cash flow is first defined by the tax returns. Number 2, additional information, financial information would be K1 statements. So that'd be great. So the second component of the personal financial information is a personal financial statement. Now, there's 2 different types of personal financial statements. One is a borrower prepared, customer prepared financial statement, where the customer literally can do it by themselves, give an estimate of what they have and be able to support it. The value of their home, the value of their car, the value of personal assets, marketable securities, or liquidity, right? Or from bank statements or retirement accounts, as well as liabilities. So how much they owe in credit cards, how much they owe in mortgages, and just, or other personal notes, when having like credit cards. So you accumulate that, it's assets, all your income and your cash minus your liabilities. That's that you owe is net worth, right? So that's our personal financial statement. Now, so that's borrower prepared, and then you have accountant prepared. Accountant assumes the risk that what they are saying is factual. And that in terms of banking, especially when we get up to the larger types of credits, 10, 20, 50, $100 million, the more sophisticated a project is, that's the more sophisticated bankers expect the client to be, more accurate, right? And then number 3, and third component, is evidence of liquidity. So this is important, and I'm going to mention the 4th one very quickly because it's simple, government ID, right? A license or a passport. But let's speak about the evidence of liquidity in detail. So when it comes to construction financing, equity in the deal, the project, is probably like number 2 in the major rungs of priority scales. Why? Because of skin in the game. And it goes to legal kind of requirements from the Federal Reserve and the FDIC, OCC, and then interagency guidelines, and then what a bank can or cannot do in terms of their lending. So let's hit it. So equity is typically a 70-30 split, 70% financing and 30% personal equity. Now, equity is typically cash, capital, that the borrower has into the deal. Now, that could be done so many different ways. Long story short, banks typically fund dollar for dollar improvements on the property because they can ensure that the dollars that they put in, the appraised value is going to increase, right? That's why when a company or bank gives their commitment to fund, they're expecting and they don't want to stop in the middle, right? They don't want a half complete project. They want a fully complete project, unless they're going to be able to do it by themselves, God forbid. Worst case scenario, the idea is that every dollar that they're going to spend, they're going to get it back in improvements. Personal equity, though, says your cash goes in first, or this is your portion of equity of the deal, and then we're going to fund. So, and then we'll reimburse you whatever X amount. So, long story short, we need to ensure that the principal or the sponsor or the guarantor has the cash liquidity funds available to them to be able to fund a portion, or that 30% portion of the general project. The more specific or difficult the deal, the higher the equity requirements, the lower the extent of financing. So let's say hotels or a church or a gasoline station, or these more volatile type of industries require a lot more equity and less financing, right? So there's guidance according to not only the institution from a procedure standpoint, policy standpoint, and then regulatory standpoint, and then there's a legal standpoint. So all of this comes together to inform the 3 steps that we've been talking about. Number 1, the budget. Number 2, the corporate information, financial information. Number 3, the personal financial information. This is Alvin, Lifeway Capital, trying to give you guys a roadmap on what it means to fund commercial construction properties.